2 weeks ago, I held a webinar about how to invest in the all-time high market because this is where we are right now and it's kind of scary. We're scared because when we look at the valuation, and the classic way would be to look at the S&P 500 Shiller CAPE ratio that you can see right there, we are getting pretty high up over the past 30 years. There's only the tech bubble and what I would call the COVID hype that showed a PE ratio that is higher than today. So definitely, I would say we're not necessarily heading towards the right direction. And what we fear the most when we're thinking about investing in a all-time high is this. This is what would have happened if you have invested your money right before the market crash of the financial crisis of 2008. It would have taken you roughly 4 to 5 years to fully recover. So the S&P 500 total return for 5 years was 8.59% total. So on a compounded annualized growth rate, it's 1.5%. If you're Canadian, it's even worse. The S&P TSX was up 4%, so not even 1% per year for 5 years. How can you retire on that? It would be a very hard, long path. However, it doesn't mean that if some stocks are overvalued, that all of them are. Many technology companies like Microsoft and Apple have suffered from what I called PE expansion, meaning that the price that investors are willing to pay is a much higher multiple today than it was 5 years ago. So for Apple, we're talking about more than 70%. For Microsoft, more than 40%. As you can see for Microsoft, it has been trading relatively steadily though since 2021 all the way up to 2024. But still, those type of businesses right now are not necessarily bad investment, but they are condemned to report double-digit growth everywhere. I remember that last time I reviewed Microsoft earnings, analysts were saying, oh, it is quite disappointing to see Azure result. And Azure is their cloud service business, which is one of their main growth vectors. And I thought, okay, so that must not be good, must be like no more growth or like very small growth. And then I look at the numbers and actually Azure was up 30% versus last year, and analysts call that disappointing because they were expecting a lot more. So one thing that I like to do when we are trading at a all-time high to find new investment ideas is to look at that PE expansion. So for stocks that does not show any PE expansion, it's probably a good sign, but there's always a source of uncertainty. So I'm going to share with you 3 companies today that I found that looks undervalued by this methodology, and also the reason why it is not trading at a higher P ratio today than it was 5 years ago. So let's get started with one of my recent play, actually, Automatic Data Processing, ADP. I bought this one at the end of 2023 when I was doing my rebalancing of my portfolio, and as you can see, it was trading at a much higher rate in 2019 than it is today. So instead of having a PE expansion, we have a PE contraction by 23%. So what's the problem? When you look at the dividend triangle, you don't see much, right? Even last week in my video, I used ADP's dividend triangle as a good example. Revenues goes up, earnings per share goes up, the dividend goes up, everything seems to be perfect. But while earnings are going up over the past 2 years, the stock price maintains the same thing. So in other words, every year the PE ratio decreases instead of increasing. So the magic about automatic data processing is it's one of the leader in an industry. So it benefits from economies of scale. It benefits also from a very sticky business model because they are taking care of payroll for most of the largest employers. And those guys, and even actually myself as a small employer, I don't have the priority of changing my payroll manager every quarter, right? Once everything works well, I just stay there and I just pay a recurring fee on all the employees I'm paying everything and it's all fine, I don't mind about that. Well, big employers, pretty much the same thing. So they benefit from that sticky business, predictable cash flow, and they're always growing as HR has become more and more complicated, so they offer a lot of solutions over there. There's a lot of growth opportunities. They also show almost 50 years of consecutive dividend increase, which is kind of crazy. They're going to become dividend king this very year. So what's the problem with ADP? Well, the thing is, we expect a recession. We expect an economic slowdown. And if this happens, well, that means also that they're going to get less revenue for a temporary moment, where if we have less people employed, well, they will have less fees to collect from employers. But that is more of a temporary thing. So this is one of the reasons why I decided to add ADP to my portfolio. Another one that didn't get much love these days is StarBucks. This one is kind of like a bit crazy because during the lockdown of 2020, especially because one of their main growth vector is China, and in China they did like so many lockdowns, well, the PE ratio skyrocketed back then because earnings were going down very fast, but the stock price did not follow as well. So when you see big pikes like this or big drops, you have to add context to it because it doesn't mean much to trade at a PE ratio that exploded 4 times, right? So you're better off looking at a larger time horizon. In this case, you can see that in 2019 versus today, the latest drop is more about 23 to today, which is 25%. So again, what's happening with StarBucks? Well, when you look at the dividend triangle, this one got a drop in 2020 to 2021, which it's explained by the COVID. But since then, revenue keeps increasing, dividend keeps increasing, earnings keeps increasing. So how in the world the stock price do not move like this, right? Interestingly, the company keeps also opening new stores every year. So in 2023, for the full year from their annual report, you can see that they have opened more than 1,300 net stores. So all the stores open minus those that they closed, and they keep on growing. Obviously, most of the growth is coming from international market, not necessarily in North America, but for this year in North America, they were still up by 412 new stores. So what's the story here? What's the uncertainties? Well, first, you have inflation that is hurting, you have higher wages that is hurting, and also all the union problems. So you have competition in China, that is also another thing. A lot of employees are asking like better condition. It's kind of like crazy to work in a Starbucks now because people are looking for a caramel macchiato with a shot of espresso and 2 syrup of this, and then you have to twist it all the way around and then do double shots of anything else, and before that then they have their special drinks. Well, creation of those takes a lot of time, and it's kind of crazy when you have like that rhythm. There are a lot of other problems, so that could slow down the business going forward. So as you can see, the reason is not the stats are still good, the financial metrics are great, but moving forward, the market is a bit worried about this one. Full disclaimer, while I added ADP not too long ago, I own Starbucks since 2017, and I intend to keep having it in my portfolio. Last but not the least, I wanted to highlight a stock that I looked at it for so long. It was sitting on the bench there on my buy list, but I could not decide myself to pull the trigger due to a high PE ratio that was constantly above 30 times its earning. Visa is actually trading pretty much at the same price it was 5 years ago when you look at the multiple. Of course, you have a lot of volatility, but in the end, you're paying the same multiple today than you would have paid in 2019. So what's the secret with Visa? Well, when you look at the dividend triangle, it is definitely crazy. Even between 2020 and 2021, the drop was not that much. And after that, COVID spending, let's call it that way. Visa revenue continued to skyrocket, earnings followed, and of course, dividend followed as well. Now you're gonna tell me, but Mike, Visa is another like super low yield. I'm not interested in that. That doesn't make any sense. It's trading at the highest price ever. So why in the world would I listen to you? I'm like, okay, so how about a company that grows their total volume of transaction all the time? That the payment volume also increase all the time, and all the transactions increases, the number of cards increases. And let's take a look at the valuation now a second. Currently trading at a P ratio of 30, forward P ratio at 28, so still in line with what they offer. Remember what I told you about Microsoft and Visa, Microsoft and Apple not too long ago in this video? I told you that those type of companies are condemned to report double digit everywhere. Well, for the past 5 years, the compounded annualized growth rate of revenue is at 9.65. The earnings is at 13%, and then the dividend is at 16.9%. So you're doubling your dividend very quickly, even though it's a small portion. So when I look at what I received between 2017 and today, I would say I'm pretty happy with the performance of Visa in my portfolio. It is now up more than 100% in 6 years, plus the dividend. So that is just a great investment in my opinion. I intend to keep it, even if it's a low yield. You can see that right now, you're not paying more or less than what you were paying 5 years ago. So it's not trading at an overvalued price. It is the valuation as long as the company can keep up showing double-digit growth. But being the largest payment processor in the world, looking at how those transactions that keeps on being used with a card, it is an incredibly sticky business, and I'm pretty sure it's going to continue that way because they operate a duopoly with MasterCard. So if you don't like Visa, you may like MasterCard. In my book, it's pretty much the same thing. So that was only one trick that I've presented in my webinar to look at the P ratio versus the average 5 years. I have 3 more tricks plus a bonus strategy to help you invest. So click on the link description below, dividendstocksrock.com/webinar. Dividendstocksrock.com/replay, and then you will get directly to the replay with the webinar. You will get the 4 tricks to invest today at the all-time high plus a bonus strategy. If you have enjoyed this video, give me a thumbs up, leave me a comment below, and make sure that you follow this channel for the next video on next Thursday. And until then, don't forget to stay invested.